Good evening, everyone. I'm Ross from Smith 150 Group Property Accountants, and obviously we're here tonight to speak about rental property basics. Um, so obviously the whole idea of this webinar is to answer questions and to help you about the basics of property investment. The whole thing is designed for beginners and people new to property investment. If you've got a whole lot of properties, you're most welcome to watch, but you might find it a little bit boring and hopefully a little bit below your level. Um, yeah, what I try and do tonight is just go through the real basics of property. If you've got some questions, we'll allow that. And basically you can answer questions as they go along. If it's something complicated about property investment, I'm not going to answer it because it's about basics. If it's on a slide that's coming up, I'll wait until that slide comes up, and you might just see me pause a little bit at the end of each slide just to read questions and decide which ones to answer. So start off just a little bit about myself. I'm Ross Barnett, as I said before. I've been running Smith Property Accountants for the last 16 years. I'm heavily involved in property. So I'm a member of Waikato Property Investors Association, have been, I think it's coming up to close to 20 years, and I've been on the committee for the last 6 to 7 years. We used to trade residential property. We do hold long-term residential property. We trade commercial property. We hold long-term commercial, and we also do subdivisions. So I basically live and breathe property all the time. And lucky enough, we have merged with 150 Group recently on the 1st of April, which was fantastic timing. And it means that we can bring you a whole lot of other financial advice and information. The team at 150 Group often work with people about their goals, their financial plan, retirement plans, checking their investments, KiwiSaver, working well with them, and seeing what loans they can get and helping with their loan structure as well. So we'll give you a little bit more about that later, but now getting into the things you're here to see about, which is property. So just a disclaimer to start with, this is general information. It's not specific advice for you. So if you're looking at buying a property, come and see a property accountant like me, get some specific advice. And it doesn't really matter where you are in New Zealand with Zoom meetings. They're a fantastic way of meeting. And we actually get a whole lot done in a Zoom meeting, a whole lot more done in a meeting than a Zoom meeting than you would in person. And we can also record it, share screens and things like I am now. So we'll start off with some basics. First of all, why would you look at buying property? And obviously, to me, there's two things that you want to aim. You want to have a debt-free personal house long term, and you want to have a passive income. The key thing is it's looking at your level of your aims. What do you personally want? Someone else might want a mansion. You might be happy with a little house. Someone else might want 300,000. You might be happy with 30,000 a year passive income. It's setting it all based on your criteria. Don't worry about what your friends or family are up to. It's about what you want to do, your aims and goals. What sort of level of life that you're happy with and wanting. But ideally, we want a debt-free personal house and some sort of passive income coming in. What do you need to achieve this? Cash and a high-paying job? Well, obviously those things help. If you've got $1 million sitting there, then obviously it's going to help us get a debt-free personal house and some passive income, but it's not actually essential. And a high-paying job is not essential as well. Many successful property investors and most people don't have a whole lot of cash or a high-paying job. So what you do need is a long-term strategy that works for you. You need to think about, what sort of property helps you achieve your goals. And you need to look at two things. You need to look at cash flow. What cash flow do you need? And what is your cash flow from other sources? And how does that link in with your property investment? And equity gain is the second thing. So why do we focus on both the cash flow and the equity gain? Well, to start with, for most of us, we're wanting to borrow the money, and banks want both. They want the cash flow and they also want equity. So if you're wanting to buy more and more properties, you need to focus on both. Obviously, at the moment, with COVID still sitting around, it's really important to have cash, and it's the old saying, cash is king. So you need cash to survive through this sort of period. If something goes wrong, you need a buffer. So cash is really important. And obviously where property does really well is the long-term equity gain or increase in value over time. So what we're really looking at with property, this is a graph of New Zealand back in 1996, and basically what's happened over the past. The green line is 6.3%, so you can see basically that New Zealand goes up 6.3% up till now, and therefore the prediction in the future would be prices go up. The blue line is Hamilton, where I'm based, and the red line is New Zealand. So generally the market goes flat, and then booms, flat, and then booms. Therefore, the guess would be flat and then boom. Obviously, with COVID, it's a big guess, and no one has a crystal ball. No one knows what's happening. In the next 2 or 3 years, to me, it's a really big guess. I'm not going to try and guess what's going to happen in the market because, to be honest, I don't know. I could argue either way, and you sort of have to be prepared for either. What I am thinking long term is banks are printing money. It's going to cause high inflation. I would not be surprised at all to see the 6.3% value keep going, and houses go from about 600,000 median now up to $1 million long term. Interesting things on this: interest rates at the moment, what, 2.65%? Last global financial crisis back at the end of 2007, 2008, we're looking at interest rates about 8 or 9%. So a huge difference in interest rate, but obviously the prices have also jumped up. Here we had some employment and some hard times. Here we're getting a lot of unemployment coming through, wage subsidies stopping, things like that. We're also getting a lot of Kiwis coming back to New Zealand though. So yeah, lots of different factors. It'll be very interesting to see what does happen in that period. Generally, Auckland leads the market first, so New Zealand market jumps up, and places like Hamilton, Tauranga lag behind a little bit and then slowly start to jump as well. So it's often really interesting to see what happens with Auckland, because then sooner or later Hamilton, Tauranga and the rest of New Zealand follow along. So if Auckland's gone flat, which it has at the moment, maybe even slightly backwards, it generally means that Hamilton, Tauranga and the rest of the country are in for the same sort of thing. When Auckland booms, it can actually be quite an amount before the rest of the country catches up. So yeah, really interested to follow Auckland and see what happens, and then you can see what could happen for the rest of New Zealand. This is a really simple and common strategy that's worked really well in the past. So maybe you buy 4 properties. Maybe they're worth $500,000 each, for example. So you spend $2 million on property. You hold them long term. You hold them for 10 years, and maybe those properties double in value over that time. Obviously, we don't have a crystal ball, don't know what will happen in the future, but that's worked well in the past. Maybe you sell 2 of the properties. So they've doubled in value. They've gone from $500,000 each. They're now worth $1 million each. So you bought the 4 properties for $2 million. You borrowed $2 million. You sell 2 of them 10 years later for the same $2 million. So it means you're left with 2 debt-free properties. So yeah, obviously that can help you. A slight twist on that is you might actually sell 3 of the rentals, then end up with 1 debt-free property, giving you passive income and a debt-free personal house. So this sort of strategy has worked really well in the past, and it's been a great way of getting a debt-free personal house and some passive income. Going forward, you just need to think, yeah, how likely is that capital gain? Is there a higher risk? And I think there definitely is with COVID. So what you're really trying to do is get better cash flow properties so that they're solely paying for themselves and giving you cash flow. So you're not so reliant on the capital gain, but you still want this sort of equation to happen. That's some real basic property information to start with. Now I'm going to get into the nitty gritty a little bit and get into the numbers. I've got 3 different examples to run through. And I'll give you a little bit of basic information and then run through those 3 properties. So the first thing I look at when I'm looking at a property is, what is the gross yield? So the other day I was looking at properties, and I look around. The rent was 67,000. The purchase price was $1 million. That's pretty easy to work out. 67,000 divided by $1 million is a 6.7% gross yield. That straight away gives me an indication that's in Hamilton, that the cash is going to be quite good, and that's going to be quite positive cash flow. Whereas on the other hand, if it was only 40,000 of rental income over $1 million, that's going to be only a 4% gross yield, and it's going to be a lot less cash flow. So when you're comparing similar things in the Hamilton market, for example, you can use the gross yield as a quick indicator. If you were going to compare that with Whanganui, it's completely different. Whanganui, the rent is a whole lot lower. You're going to get a whole lot different market, so you can't really compare a Hamilton gross yield with a Whanganui gross yield. And just because the Whanganui one's 6% doesn't actually mean it's a good rental, whereas 6% in Hamilton, Tauranga, Auckland will generally give you a good cash flow. I always get independent rental appraisals. So yeah, you're looking at buying a property and the agents say, oh, you'll get 400 a week. Well, if I'm getting serious, I would always get a separate agency, a separate property manager, completely unrelated to the sale, to appraise what that rent should be, and to work out what the property market, what the rent should be. Sorry, just excuse me for a second. Next thing I look at is I look at the full cash flow. So the gross yield gives me a quick comparison and it gives me a basic indication, but I'm really looking at what are the full numbers. What's the rent, less all the expenses, what's the profit or loss from that? And the best tip really for tax is to get a chattel's valuation. Yeah, we see it all the time where people buy a property, even see it from other accountants buying rentals, and they don't depreciate all the chattels. So the carpets, the curtains, the dishwasher, stove, the heat pump, mirrors, fences, TV aerials, paths, driveways, all the separate components can actually be depreciated. So if it's a brand new house, that can give you a huge tax benefit. So if you're buying a house with reasonable chattels, get a chattel's valuation, and it's from a firm called Valueit. And my last slide will have their details, and we'll send you through an email with their details on it as well. But yeah, really worthwhile thinking about that. And if your current accountant's not doing a chattel's valuation, yeah, I would have a serious think about, yeah, coming and have a chat to someone like me, because you could be missing out on thousands of dollars. Cool, so we've got some options we're going to run through. We're going to run through a new property. What's the cash flow like on that? Low-hanging fruit, what is that and what's the cash flow on that? And then I'm going to discuss around the more complex examples. I won't actually give them in this webinar, but some of our other webinars does have examples. So what we're looking at is a new property. The big thing is often new property is not the best. The best is often going to be buy an old house that you can subdivide and put 6 houses on it. But that's obviously very complex and a lot of things very hard to find. Yeah, a lot of skills needed for that. Whereas a new house can actually do reasonably well for you and it's easy. You're going to get good tenants. It already has insulation. It meets the healthy homes rules. Yeah, easy to sell if you have to sell, low repairs and maintenance, high depreciation, a whole lot of good things happening for it. And some people would say that you'll get higher capital gain. I don't know whether you can ever actually prove that, but you've got a whole lot of different things that will happen for it. So the normal issue with new property and why people don't like it is the cash flow is normally terrible. So in the past, new properties worked really well if you've got some cash or you've got a really high income. But yeah, in the past, always that cash flow has been a little bit of a problem. I've got a great question which I'll answer shortly about chattel's depreciation. I'll leave it for a couple of slides and then I'll answer it. So you're really good if you've got high income or cash. But what you can think about is things have changed a little bit. Interest rates have dropped so much. So we're going to look at this new house. This is a Signature Homes brand new house out in Rototuna, which is in northern Hamilton. Obviously a nice, good looking house, and it's a little bit different. We've got one house here and we've got an income. So it's a home and income property. So this next slide shows it a little bit better. We've got a 2-bedroom unit in the white or the light. And then we've got a 3-bedroom house joined onto it. So you've got 2 different houses, 2 different income streams. And obviously it costs quite a lot more, but it's an interesting example of how a new build can actually work quite well. So this property costs about 1.1 million, and I realize that's over most people's budget, especially if you're new to property, but it is interesting to look at that something like this can work, and there is cheaper new builds out there which can actually work reasonable as well. So I add in legal costs. Maybe you need a valuation, setting up a company. There could be a building inspection or something like that. So there's other costs to buy which are going to add to your total. Generally, you'd get a cash contribution from the bank, and I'm being really tight with the $1,500 that I've put in there. You can hopefully get a lot more than that. But basically, you're looking at borrowing about the 1.1 million. First key thing to look at, I always work on 100% debt. So you've got 300,000 you're going to put in this. Awesome. To start with, look at it with 100% debt. And it's all about you can get, if you've got 300,000 in cash, you can get a return on that money. You could invest it in the bank, in your KiwiSaver, in some shares or in something else and get a return. So therefore you want a return on your money. So it's important to look at it that you're borrowing the full 100%. Otherwise you're just kidding yourself and you're making a bad rental potentially look good. So the numbers on this, whenever I see $1,000, I get really, really suspicious. But this property, the median from the property manager who appraised it, actually was $1,000. So the two bedroom plus the 3 bedroom added together to $1,000 a week. It's brand new, so I'd work on 52 weeks. If you've got a really old house in Tokoroa in a terrible area, it's run down, you're not going to get 52 weeks. So make sure you work on less than that and be realistic with your vacancy. If it's a 1 bedroom fully furnished unit, you'll find your tenants do a runner. And again, you probably won't get 52 weeks. So yeah, important to look at that. This case, 52,000 divided by 1.1 million is a 4.65% yield. So normally I'd be thinking, oh, it's a little bit low, there's not very good cash flow, but with interest rates being so low, it really makes a big difference. So then I look at all the expenses. I've got accounting, I've got insurance. It's higher than normal, but you've still got 2 houses on one title. Interest, 2.65% at the moment. Property management, rates maybe 3.5 for the 2 houses. Repairs and maintenance, it's a brand new house, so your repairs are quite cheap. Seminars, maybe you join, get a little bit of property education. Subscriptions, maybe you join Waikato Property Investors Association, and a little bit of travel to and from the property. Had the first question ever on why I had $86 in there from a person, and when I last did this and changed around the travel figure, it's because the AA rate was 86 cents per kilometre, 100 kilometres, so yeah, I rounded the kilometres, not the dollars. But basically you can get a reimbursement based on travel. Income 52, expenses 44, you're looking at making about 7,000 positive. I just updated this slide today. I had 3% in there and that worked out about 4,000 positive. So the 2.65 has actually made a big difference and made it more positive. So for a brand new house, really good area, you're actually starting to get some pretty good cash flow through there. And obviously, yeah, if you put this on principal and interest, that's not going to pay all your principal, but maybe you could split your loan up. So instead of having a 1.1 million loan, maybe you split it up 3 lots of 350. And I know that doesn't add exactly to 1.1, but it gives you an idea. I might fix 1,350 for 1 year. Interest only. I might fix 1,350 for 1 year, but do it principal and interest. So then I'm putting the surplus into paying down the debt, and obviously that's a winning cycle. The more debt you pay down, the less interest you have. The less interest you have, then the more profit you make. Then next time you're going to have more money, you're going to cycle it back in, pay down more debt, less interest, more profit. So it's a winning cycle. It's going to get better and better and better the more you pay down the debt. The last 1/3, you might do a higher rate depending on your risk levels. You might look at a 2 to 5 year term because you're more worried about security than the lowest rate. But yeah, it gives you different options if you split up the loan. Then we look, you're making 7,395, which is great, giving you some cash in the hand. Then we look at what can we do to reduce the tax. In the past, we could we could depreciate buildings. So we used to depreciate them down and down in value. Realistically, they were going up and up in value. So that resulted in generally recovered depreciation on buildings. It was still a good thing. It was an interest-free loan on the building depreciation. It reduced your tax. It was interest-free, no penalties. You might have to pay it back later. Building depreciation all stopped on the 1st of April 11, but we can still depreciate chattels. So things like your carpets, curtains, dishwasher, stove, heat pumps are the major one. They all wear out in value. So generally you get really high depreciation on them, reduces your tax. So this case reduced the 7,000 profit down to a small loss. And generally you don't have to pay that back. Your chattels do actually wear out. So generally you have no or very low depreciation recovered on chattels. So it's really good. You claim high chattels, you reduce your tax, and you don't pay it back. Chattels valuations are awesome, and chattels depreciation is great. And like I said, Value It is the only firm I would use, and their details will come out to you tomorrow and on the last slide as well. We're making a small loss for tax purposes. In the past, you could offset that loss against your personal income. From the 1st of April 19, ring fencing is set in, and you can't offset that loss against your personal income. So for a normal person with one rental, you can't offset it against your personal income, no tax refund. So you'll get zero tax refund, but you're still making about $142 a week from this. If you've got other rental properties making a profit, you could then offset that against it. So that's all in good. We're making this cash flow profit. It's looking good, but obviously, what's the problem? We're at 2.65%. What happens over time? What happens if interest rates go up? And we need to consider that's a likelihood that we're down to really low interest rates. Maybe they could increase a bit. So I'm being a miserable conservative person, and I'm saying interest rates will go up to maybe 5% over the next 10 years. And I look at the numbers there. So I look at what will happen at your property value if it does go up to 6.3%. So it'll go from 1.1 up to 2 million. Your rent, if it goes up 3% a year, will go from 52 up to 66,000. All your expenses will go up over time, and your interest will go from, if it goes up to 5%, will go from 30,000 up to almost 50,000. So a huge change there. So what happens overall is your total expenses go from 44 to 69. You go from a profit of 7,000 actually into a loss of 3,202. So in my 10th year, being miserable, saying that we pay off no debt and just keep it exactly at the 1.1 million debt, it's going to run at a small loss. So good things with that is without paying down any debt. So what you're really looking at overall 10 years is we're estimating an $840,000 capital gain. We've got a cash cost. I'm just going to check that because I updated my numbers and I have a funny feeling that hasn't updated. With the lower interest rate, that was based on 3%, basing it on the 2.65 for the first year and still building up to 5% long term. It's down to 7,393 cash, actually cash that it'll put into your pocket over 10 years. So even though your last years are running at a loss, those earlier years putting in a big profit means that overall, rather than a cash cost, just the interest rate's been lower for that starting year has actually made it a 7,000 surplus over the next 10 years. And that's been with me being a conservative person, basing interest rates on going up to 5%. Personally, I can't see them going up to 5%, but it is good to paint a conservative picture rather than look at everything being rosy and then getting caught out later on. So as a whole, yeah, the home and income as a brand new rental actually works quite well. It's got quite good cash flow. It gives you a small cash surplus over 10 years. And if you recycle that surplus into paying down debt, then yeah, that's going to end up with less debt, less interest. It's going to make more and more money from it. So our cash surplus will actually go up over the 10 years. Just got a question here. Can we get a recording after this? Yes, you can. Yeah, if you send us through an email afterwards, and my email address will come up at the end, or yeah, in the email tomorrow, then we can send you through a recording for it. So that's the first one. Yeah, new build is actually not a bad option. It's really easy, simple, brand new house, easy to get tenants. It's going to be good for the next 10 or 20 years. So to me, that's a great part of your portfolio. If you're looking at buying 10 or 20 investment properties, it could slow you down a little bit. If you're looking at being more conservative on one or two, it could be a really good addition to your portfolio. Next thing we're looking at is low-hanging fruit. And it's all about maximizing what you already have. So all the time, everyone looks at, oh, what can I buy next? What can I buy next? Well, the easy option is just look at what do you already have. So do you have a personal house that's got a huge section? Can we subdivide that? Do you have parents or other family who've got a large farm or a big section that you can do something with? Do you have a rental that's got, yeah, a section, or it might have, for example, a big garage underneath that you could turn into a sleep out? Could you turn a 2-bedroom into a 3-bedroom? Can you do Airbnb? Yeah, even a renovation can be very good. So spending some money, and we use it as an example in one of the other webinars, spending some money on renovations can actually improve your return and improve your cash flow. So rather than my first thing going, let's buy another rental, first step should really be, what have I already got and what can I do with it? Is there some really big options with that? So the example we've done is a minor dwelling. So this is a little 58 square metre example of a minor dwelling from Signature Homes. The size depends on what council you're in. So generally the councils allow under 60, hence the 58, or 65 square metres. And generally it's a 2-bedroom property. It's brand new, easy to get tenants, brick and tiles, so it's, yeah, low repairs and maintenance, insulation, double glazing, warm, reduces your power for tenants, meets healthy homes, all those sort of things. And what we're looking at is the numbers on this. So a minor dwelling in Hamilton normally costs about 220,000, and it depends a lot on your council contributions. You're going to spend some cost, maybe a valuation to get it, and maybe you'll get a contribution back from the bank, but basically borrowing 220,000. If you get 52 weeks at 350, and I'll talk a bit more about that in a second, it gives you 18,000. 18,000 divided by 220 is an 8% gross yield. So before, our new build example was 4.65, this one's 8. So suddenly you know there's going to be good cash flow on this property. I've been a bit miserable and I've said maybe you're conservative and you're going to go for 3% interest rate, and you're going to base this on a 5-year fix so that you've got security. If you put in the 2.65, obviously that's going to decrease your interest quite a lot, and your interest would come down by about $800 if you did that. So we've got accounting, we've got insurance going up a bit, we've got the mortgage, we've got property management, we've got your rates, we've got low repairs because it's brand new, 18,000 in, 12,000 out, you're looking at making about 5,500. So reasonably good cash flow from a small outlay. Less depreciation will bring your tax down to virtually zero. And what would happen, we would never structure the shareholding like that. We wouldn't want 99% by the highest earner, but it just gives you an example of what the tax could be. In reality, what would happen is this property is using some of your backyard to put the minor dwelling on, so you would claim a portion of the interest on your backyard or your personal house. So this would go up a bit, your profit would come down, you'd end up with no tax in reality. If we look at a 10-year picture, the property should go up in value, the rent should go up, all your expenses go up, and I've got interest going up to 5% again, and your cash flow is really good. Even with interest rates going up, it's still going to be very positive, make good profit, and you're slowly going to pay more tax. And like I said, you'd be looking at opportunities to structure it differently to this. You'd be trying to get the income out to the lowest earner, not the highest earner, and we'll talk about that a bit later on. I'll just have a quick look through questions and see what we've got. Is it possible to do interest only for 10 years? It depends on the bank and things, and often people will shuffle around between banks to get it. Lots of banks prefer short term. They want your interest only for a couple of years. But yeah, it is possible to move around and get interest only for longer. I personally like paying down some principal, so I would be trying to pay some principal, because to me, it's just a winning situation. If your loan goes down, yeah, you're getting less interest, you're getting less cost, more profit left, and you're building a buffer in case something goes wrong as well. So everyone will talk to you about how you must pay down your personal house first. But in reality, I would actually put some money into the rental and pay that down as well. When do you start claiming chattels depreciation? Well, ideally you do it in the first year. So IRD would argue that is your only option, that you should do it in the first year, whereas most tax experts would agree that you can actually backdate it a little bit. But yeah, if your old accountant hasn't claimed it the year before, say 2019, I would then start in 2020 if it's a newish property and got good chattels. If it's longer than that, if it's you bought it in 2017 or 2018 years, you're getting really too long ago to establish the cost price of your chattels. So it would be very difficult if it's a number of years. If it's just 1 year missed, yeah, then I would go for it. But generally, you want to do it right from the start. Do it in your first tax return the first year. So the idea with a minor dwelling is basically get good cash flow. I put 350 a week in there. In Hamilton, when we talked to QRM, Quality Rental Management, who is one of the property management firms in Hamilton, they said you generally get 430 to 460 for Hamilton. So that would be a 10% gross yield or 10,000 positive cash flow based on a 3% interest rate, which is obviously quite high. The big issue about minor dwellings is you've got one title. So normally you might want to sell a house to a first home buyer because it's a big market. If you've got two houses, no first home buyers. You're generally looking at a family with a really large family, or someone looking for home and income, or an investor. So your market is much smaller, so you could potentially get less capital gain. Generally with minor dwellings, if you're Auckland, Hamilton, Tauranga, Wellington, Christchurch, the rent is going to be really good. You're going to get a fantastic return. If you're someone lesser area like Taupo, for example, you'd want sort of that 350 a week example that I used before. You'd want this 350 a week, I think, to make it worthwhile. Anything under that, it's probably not. But yeah, if you're getting in better areas like Hamilton, Tauranga, Auckland, yeah, very good cash flow. Yeah, very good to get extra money flowing through from that. Cool. Onto my last sort of option to discuss through, and I'm just discussing through that. There's a lot more complex things that you can do. So generally, if you do a subdivision, you're taking a higher risk, so you want a higher equity gain from it. There's no way I'd do a subdivision if you only made 20,000 capital gain from it. You're looking at making 100, 200,000. You're looking at making a big amount of equity gain. Otherwise, why would you bother? With low interest rates, you should get really good cash flow. So when I look at a subdivision and opportunity, I'm looking, how much has the equity gone up? Are you worth a lot more than you were before and have more equity? If not, why are you bothering? And you also want the rent to pay for all expenses, give you good cash flow so that long term you can pay down that debt. You're looking at a lot more costs. Yeah, subdivision, Hamilton, you're looking 50, 60,000. Auckland can be 100,000 or more. Other areas can be a lot cheaper, but you're looking at quite a lot of costs. And then if you're building a new house, you're probably looking at least 300,000 for the new house. A little tax tip, if you do subdivide, generally you have to consider tax. If you build and keep and don't sell, then you've got no tax. So I'm just going to have a drink for a second to try and get my voice going a little bit better. Sorry about that, but yeah, hopefully it'll last now. So if you build and keep, then there is no tax. So it's just a handy little trick for the subdivisions. And we've got other webinars coming up later this month that go through more subdivision opportunities and a little bit on the tax and things like that. Other things that you can look at doing, the more complicated, is rent by room. Renting a 5-bedroom house to one tenant is easier. If you rent it to 5 separate tenants, it's more complicated. You've got 5 people to deal with. Generally, property managers don't like it. You've got things like, what happens if they use the dryer 24/7, the power running all the time, heaters running? How do you manage that power? Because generally you have to pay it, and same generally you're having to pay the internet as well. Fully furnished is another option. Generally means you can get more rent, and it can work in some places. But yeah, just talk a lot to your property managers about whether that works in your location. Airbnb, if you're going to earn more than 60,000 a year from them, watch GST and get some GST advice. Commercial property, generally your risk with that is you could have a vacancy for 3 months, 6 months, a year, and that's a big risk. I'm sure you've seen some great commercial properties that have just sat there empty for a while, and that's the risk with commercial. It's much higher risk. So yeah, that's just a few other things to think about, but often you'll find residential property just so much easier. Someone's asking questions about the tax split. I'll do a little bit about structures in that in the future. And yeah, there's different structures that can split your profits in different ways. and therefore split your tax in different ways. Second thing I look at is where. And to me, I like bigger cities. I like people. If I have to sell my house, I want lots of buyers. If I have to rent the property, I want lots of tenants. I want lots of jobs. I want lots of infrastructure. I don't want just one freezing works that I'm relying on or one employer. I want lots of options so that, yeah, if something happens, I'm not in a lot of trouble. I prefer closer to home. Yeah, something near to you. To me, everywhere in New Zealand there's opportunities. You don't have to go for a certain area, and I generally don't chase the next big thing. You'll hear people go, "Oh, Invercargill's booming." Well, maybe it is. Maybe it's actually already boomed and you're too late. Or Wanganui's booming, or Gisborne's booming, or there's no rentals available in those places. That can be true. But what I'm really looking for is I want something that is long-term sustainability. I want something that I can buy, add value to, rent long-term, the next 10 or 20, 30 years. I'm not looking at just chasing the next boom, then 2 or 3 years selling it, and then trying to chase the next thing. That's a lot of hard work, and that's a speculator, whereas a long-term investor is really looking for a long-term sustainable plan. And yeah, to me, there's opportunities everywhere, and yeah, close to home is a little bit easier. We've got a great couple of examples with why they're closer to home. Both of these are experienced property investors who are in the North Island. One bought a property in Invercargill. Great rental property. They bought it sight unseen. They never went down to Invercargill, never flew there, just believed the real estate agents and the property finders and everywhere else. And it turned out that they were right next door to the sewage works. And that's a true story that can happen. They were experienced people, but they just missed a thing. Yeah, that the sewage works were there. So they ended up buying a cheap property, probably for a reason. And obviously, if you were buying in your hometown, you're not going to make that sort of mistake. You're going to know where those key things are. So that's one reason. The other one, another really experienced property investor in the North Island, they got a house painted down the South Island, and the painter did an awesome job. It looked really good. They sent them through a picture and just looked fantastic. So the property investor paid the bill and happily as, really happy with it, moved on. 2 or 3 months later, they were talking to their property manager. And yeah, this property's down the South Island, they're in the North Island, and the property manager said, well, why did you paint just 2 sides? And what had happened is the painter had painted just 2 sides, taken a picture showing the 2 sides and showing how great it is. They actually didn't paint the back 2 sides. So yeah, the property investor got ripped off, and obviously that would be another thing that wouldn't happen if you're close by, because you can check things like that. What would I buy? To me, the key thing is something that I would live in. It doesn't have to be your dream home. You don't have to be really happy there, but it needs to be an acceptable home that you would feel safe in and comfortable in. If you're too scared to park your car outside because the wheels are going to go missing, or there's something else wrong with the property and you couldn't live there, I think you'll have problems tenanting that. You want something versatile that's got a large market. So an 8-bedroom house probably has a very small market. Something way out in the country, 50 minutes from town, is going to have a small market. You want just a normal house in a normal market, easy to rent, easy to sell if you had to. Ideally, you want something low maintenance. I hate brick. I think brick is very, very ugly, but it is low maintenance that can save you a lot of costs in painting long term. I quite like the new properties or opportunities. So new means that it's going to be a good solid rental for the next 20 or 30 years. No repairs and maintenance, or very low repairs and maintenance, good tenants, meeting all your healthy homes. Or I'd look for an opportunity, something where you could subdivide, put a house on the back, or put a dwelling, like turn the garage downstairs into a separate unit, something like that. That's generally what I'm looking for. And a combination of the two can be great. It's building that long-term sustainable portfolio that you're after. How do I find it? And I suppose the box gives it away. To me, you have to look outside the box. If you go along to just your normal auction from Harcourts, you're going to struggle to get a real good deal. If you look through Trade Me like everyone else, you're going to struggle to get a real good deal. So what you have to do is look for different properties. So building up a relationship with an agent can be one strategy. I purchased my last property through a really good relationship with an agent, and she's currently working with me with another deal. The other deal has got no people looking. There's no one else negotiating. There's no multi-offer. It's actually not on the market at the moment. So that's what a relationship with an agent can do. It can bring you in so you've actually got time to do your due diligence. I can check, can I subdivide it? I can get it under contract for a period of time so I can fully investigate all the issues. This is a commercial property. It's got subdivision issues. It's got earthquake issues. It's got tenancy issues. You need some time. So yeah, having that relationship with an agent can bring you opportunities like that. At the moment, we all don't know what's going to happen with COVID-19, but to me, there's bound to be some people who freak out and panic, and that can create opportunities for buyers. So it's a matter of using that to your advantage. Having a specific plan can help when you go to agents and say, I want a lifestyle block that's more than 7,500 square meters and it's within 15 minutes from Cambridge. By being very specific, it's easier for them to find something and easy to remember what you're actually after. Flyer drops never ever worked for me, but it can work. So what a flyer drop is basically you do up a flyer, nothing too professional, nothing too fancy. A picture you, your young family, and your little puppy. And then you drive to the road and you physically walk up and down the street with your family. And your flyer might have, hey, we're a young family, we'd love to buy in this area because of yeah, my parents live there or something like that, a couple of reasons. Is there any chance that you would look at selling? And you get people who hate agents who are looking for a quick sale and you might just get lucky. Really important, don't turn up looking like real estate agents, don't turn up in your Porsche. You just want to look on like a nice normal family. And the last one, which I'll give you an example of, is an icebreaker. And I've actually got one other example I used recently in a blog. One option is targeting the lesser agents out there. So there's always bad agents and there's bad agencies, real estate agents and real estate agencies. So what I would do is target the bad real estate agencies. So if you find out there's a small agency and it's only got 5% market share, chances are the agents are not so good. You either find that it's real top of the market and they're amazing and they have a boutique little market, or you'll find out that they're quite hopeless, and chances are their listings might be underlisted. They might have sat around for a while. There might be an opportunity. So I did one in a webinar the other day, and yeah, pretty quickly I found a good opportunity that was worth looking at just by looking through the other agencies. And again, I've purchased properties from that. I've actually used a better agent, but we've actually purchased from the lesser agency. So it can be a good idea. Icebreaker, you're going to struggle to see this a little bit, and the next one's a little bit bigger. But say you own this property. You've got neighbors here, 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 here. So many different neighbors. So if you know those people, you already know the area, you know the basic price, you know the issues. And if you can go across the road and go, hey, Joe, I'm just wondering, I'd love to buy your property as a rental. Is there any chance you would be looking at selling? Worst thing you're going to get is no. That doesn't hurt. And same if you don't own a property, it could be your parents' house or your parents' rental or your friend's house, and you could look at neighbors. So yeah, here's a better picture of what's there. So you've got different neighbors that you could target. The other thing you could target is empty land. Say, for example, that there's not enough access down here to get access to the back for subdivision. There's not enough access down here, for example, but you've got this big back section. So what happens if you could buy some of this land? Maybe bring an access through here, then open up the back of your property to put a minor dwelling or subdivision on, and maybe you can put a second house in here as well. It's opportunities like that that I look for. What land is around you, and especially if it's locked in and no one can access it, is there opportunities? And yeah, looking at neighbors can be a really good idea. Just looking at a map like this, what is the opportunities? You can see these have got multiple dwellings on, so it sort of sits itself for the opportunity. And yeah, look for opportunities like that. I've got about 15 minutes to go, and I think I'm pretty much running on time. And we'll just see how we go with the next few slides. And we've still got a bit of information to go through, but hopefully we'll be pretty much on time. So, how do you buy a property? And we start off, everyone is thinking, oh, we need a whole lot of cash. I'm going to buy a property for $1 million. I need 300,000 cash. Well, generally, no. Most people don't have cash, and you generally don't need cash to buy. So I'm going to go through this twice. So I'll try and go through slowly the first time, and then I'll twist it slightly and go through it a second time. But hopefully it gives you an idea of how you would buy a property. So you've got a personal house that's worth 600,000. Your current debt is 185,000. So obviously you've got some good equity between the two. The bank will generally lend 80%. So 600,000 times 80% is 480. So 480 is the maximum the bank would lend up to. They've already loaned you 185. So there's about 300,000 of extra equity there that you could borrow from the bank and use for something else. So what we're looking at doing is buying a rental for 400,000, borrowing 70%, and the LVR rules have changed, but it's still pretty much what banks are looking at. So 70% is 280. So you're buying for 400,000, you can only borrow 280, you need 120,000. So what you do is you borrow over your personal house, 120,000, you bring that into the rental side, you're then buying it for 400, 280,000 from the bank over the rental, 120 from the bank over the personal house, you're borrowing a full 100% there, and you've still got some equity left long term. So hopefully that makes a little bit of sense, and I'll just go through it again with a twist. So your personal house, it's worth 600,000, and your debt is with ANZ, the blue bank. So yeah, ANZ will lend you up to 80% if you've got enough serviceability. They'll lend 480,000. Your existing debt with ANZ is 185,000, so they'll lend you almost 300,000 extra. So what we do is we borrow 120,000 from ANZ, secure it over your personal house. Then we go to Westpac. Hey, we want to buy this new rental for 400,000. Westpac lend us 70%, which is 280. So what we do is we take the 200,000 from Westpac, we take the 120 from ANZ, we put them together, and that buys your rental property. So generally you'd have the whole 400,000 borrowed over the rental entity, whether it's a trust, an LTC, a company, or whatever, but secured some over the rental and some over the personal house. Do I have any questions on that? Something that I just about always get questions on. Cool, so that's making sense. So you don't think that you need money. Generally, you can use existing personal home and things like that to borrow against. So key parts of finance, if I'm looking buying a rental, generally I will go to a broker and I'll get pre-approval to make sure I can borrow. There's no point going out shopping and trying to buy properties when you can't actually afford anything and you can't get loans. I would generally split the loans like I talked about. I wouldn't have $1,050,000 loan. I'd have 3 loans for $350,000 and potentially split them. Some interest only, some principal and interest. Some 1 year, some maybe some other terms. I like P&I, so you do want to concentrate on paying down your personal house, but I would still like a little bit of P&I in the rentals. And even if it's one of those loans, like I said, maybe one of the 350,000s that you would go principal and interest on and slowly pay it down. I would always go with a broker. So 150 Group have got some fantastic brokers, and the whole idea with a broker is they work for you. They help you find the best deal and what's best for you, whereas a banker works for the bank. It's working out what is the best deal for that bank alone. And same if you have insurance through your bank, I would really look at reviewing it. Generally, the policies are not very good, and it works for the bank, but not for you. If your KiwiSaver is with the bank, the same. Generally, it is not as good as the other investments, and it's working for the bank and not for you. So if you've got any of those, have a chat to the 150 Group, and they can look at different insurance products or different KiwiSaver products and what's best for you. Often these days, when you're buying a property, the banks can actually just use and get an evaluation, and they can normally actually provide that, so that can save you having to get a valuation done, which can be quite handy. Um, Question, if you had to choose between a P&I and a positive cash flow, which would you choose? Well, I would take a step back. I want the positive cash flow. And then positive cash flow means you can pay some P&I. So they sort of work together. So I really want both. I want ideally a positive property that's going to pay for itself and give me a little bit of profit left that I can then use to pay down a little bit of mortgage. So yeah, the positive cash flow is really necessary to help you do P&I. Legal. Yeah, questions here. Will the broker suggest splitting a loan and give advice? Mine hasn't and just asked me what I want to do. Is this normal or should I find another broker? Well, for a lot of brokers, going to one bank is easier. Splitting between two banks is harder, but long term, I want to get your personal house away from your rental property. So, if worst case scenario, if something happened, yeah, you have your personal house separate and safe. Also, it gives you different opportunities. Yeah, if another global financial recession hits and you lose your job or something, having separate bank just gives you more control and better long term. It is harder, so I can see why brokers don't suggest it so much, but to me, it is a better idea. But yeah, if your broker's not helping you with advice, then I would be looking at other brokers that can help you and can give you some advice. Generally, when you're buying a property, you go conditional. So, generally, to start with, you go and talk to a lawyer, you get some good advice, spend an hour with them, pay for their time, get some good clauses to put in the sale and purchase agreement. Then, when you're going out looking for properties, you can put in your due diligence clause that the lawyer's given you. And the whole idea is to get 1 or 2 weeks so that you can check things like subdivision. Can you put a minor dwelling on the back? Yeah, fire rules if you're going to separate upstairs, downstairs, that sort of thing. And the whole idea is just, yeah, trying to get you some time. Be careful with things like asbestos, with meth, just general inspections. All that takes time and money as well. When you're buying a property, and this is a new property to you, not necessarily a new house, think about insulation. You can't rent out a property if it's not insulated, and it can take a number of weeks to actually get a property insulated or even checked. So you make sure you think about that before you buy it. Make sure things are consented. There's been cases where people have rented an unconsented dwelling and they've had to pay all the rent back for a year or two, which can be 20, 30, $40,000. So be very careful and make sure you are consented, and just be careful that the healthy homes rules are coming up as well. So that's generally rules around heating, drafts, ventilations, your fans, that sort of thing. And for new tenants, 1st of July 21, all properties 1st of July 24. So just start thinking about that. And at the moment, you're meant to have a statement. I actually think that's been put out to December, but I'm not great on healthy homes. Before you buy a property, especially in Wellington or Christchurch, make sure you can actually get insurance. Don't just presume that you can. Get it pre-approved before you go unconditional. On to my last big topic, and it's who should buy it. So these are just different things. When you're buying a property, there is no golden answer. It's not you're always buying an LTC or you're always buying a trust or a company. It all depends on your circumstances, and it's really important to get expert advice. This just gives you some general information. So yeah, these are the different sort of structures you can look at. LTC is a look-through company. It's a normal company that's made an election to become a look-through company, and it means the profit or loss flows through to shareholders. We've got a trust. We've got a normal company, sole trader, partnership. Generally, I pretty much never use these two. I'm generally looking at something higher up for flexibility. So first thing I look at is how do you get the capital gains out? So say you buy 4 properties, 500,000 each, they double in value, and you want to sell 2 of them off and you want to trip around the world and pay off your personal house. Well, with a new company, that's just about impossible and it can cost you a lot of money. So I'm very cautious using normal companies. I generally don't use them because you can't get the capital gains out. Is the profit going to the lowest earner? So yeah, you're making 10,000 profit a year. You want that to go to whoever's earning the less, or even potentially children who can get $1,000 tax free. So trusts can be very flexible if you're making a good profit. And with a trust, doesn't necessarily have to be a straight trust. You can have an LTC owned by a trust would do the same thing. If you're making a loss, in the past you wanted that going to the highest earner, but now ring fencing is kicked in. So that loss is just going to be ring fenced until you make some more profit. But you can look at So yeah, why you can't put the loss against your income, you might be able to put the loss against other profit from properties. So it's important that you can offset your properties together. So think about structure for that. Compliance and setup costs. Trusts cost a lot of money. The whole reason for setting up a trust is to protect your assets. Um, but you're looking at sort of 2,000 to set up a trust. We don't form them, so I'm not trying to sell you into something. Then you'd normally sell your personal house into it for 1,000. Buy it in the trust for 1,000. That's 4,000 already. Update your wills, power of attorneys, gifting, memorandum of wishes. You're sort of looking at 5,000 total. Then to administer the trust, you probably need an independent trustee. They'll charge you a fee a year. You generally would have a meeting, you'd have a balance sheet. Anti-money laundering is a pain. You're probably looking at about $1,000 extra cost a year to run it. So 5,000 set up plus 1,000 a year, it's very expensive. Make sure you actually need one. Flexibility long term, LTC is great for flexibility. And just be careful if you've got a very clever structure and you're thinking, oh, it's dodged all the rules and made something possible. Well, generally, IRD, anything we create that's too clever is generally tax avoidance, and they will fight really hard for that. So just be careful that you're being realistic and not just being too clever and becoming a target. And generally, you want a commercial reason to back up why you're doing things. And yeah, like I mentioned before, trusts are set up for asset protection, and you need to think about what does that mean for you? What are you actually protecting from? So if you're a director in multiple companies, you're in the building industry, high healthy homes, so high sorry, my mind has gone completely high health and safety risk, or your construction, your farming, your heavy machinery, high construction, high safety risks, then yeah, I'd be looking at asset protection, which is all about a trust. So these two sort of go against each other. But if you have a high risk, yeah, you don't want to lose your personal house and your rentals and everything like that. So trust can be important. If you're lower risk, and most people probably don't really need a trust. Brightline basics, it used to be 2 years, yet changed up to 5 years. So basically, if you buy a rental property and sell it within 5 years, the gains are taxable. Make sure you understand the periods. So it's the shortest possible 5 years. So it goes from settlement date when you purchase to sale and purchase agreement when you sell. So be careful that it's the shortest. If you go under that 5 years, it's taxable. There is an exemption for personal home, but just make sure, yeah, that is for predominantly your personal home. So say you buy a section, you build a house and it takes you 12 months, you live in it for 6 and then you sell it. That's not predominantly your family home. It's not going to get you the personal home exemption because the building was 12 months, you only lived in it for 6. So you need to live in it for longer. If it's just you and you get 3 flatmates, it's not predominantly your family home. So be very careful of those exemptions. Also be very careful that Brightline is only one way you can get taxed. There's heaps of other ways, like if your intention was to sell it, if you're tainted by developments, subdivisions, rezoning, and builders' rules are worse still than there. So make sure you get advice if you're selling, and yeah, it's not just the Brightline. Ring fencing, like I mentioned before, come in from the 1st of April 19, and it basically means a property loss can't offset your personal income and you don't get a tax refund. You can offset 2 properties, so if one's making a profit and one's making a loss, but just make sure your structure enables it. And into my last little topic, before we wind up shortly, think about health and safety. Everyone thinks health and safety is a bit of a joke and there's no way you can be liable. But if you own a rental, you are PCBU, a person conducting a business or undertaking. So if you employ tradespeople, you should be thinking, is the property safe for them? Have you actually asked them about their health and safety policies? If you've got a property manager, have you asked them what is their health and safety policies? And just think about how safe is your property? Is the deck about to fall over? Is it extremely slippery steps and going to hurt someone? You potentially could be liable under health and safety. And everyone's thinking, oh, well, has that actually happened? Well, there's an example up in Auckland where it did. It's more construction related, but it could be you. So say you're up in Auckland, you're doing a minor dwelling in the back of your house and you're project managing it, and you're getting trucks going in, doing the driveway, and there's trucks and diggers come in, digging up the site. doing the driveway and they've messed up the footpath. The footpath's all broken up, and I'm sure if you've walked around town, you've seen broken up footpaths. Well, then in this case, unfortunately, an elderly person came along on a mobility scooter. They actually fell over on the broken up footpath because it wasn't safe, and they killed themselves. Extremely unlucky and extremely unlikely, but it did happen. That developer or the property person doing it got a $500,000 health and safety fine. So think about health and safety a little bit and just think of what the consequences could be. That is pretty much me for tonight. So what's going to happen from here is we'll flick you through an email tomorrow. It should come through about this time tomorrow. It'll have my email address on it, which is also on the next slide. And basically, we're suggesting to you, whatever stage you are in property, is book a free chat with me. What I do is I look at two different things. I look at setting you up with a free financial success plan or review with 150 Group. They look at what is your goals, your financial plans. Is your KiwiSaver investments working in the best way? What's your retirement plan? Can you borrow more money? Is your loan set up right? So they look at all your sort of money management, your finances. And yeah, we get some fantastic feedback, and it generally helps a lot of people. And then the second thing I quite often do is I meet with people, and we call it property investors. A property advisory meeting. It goes for about an hour. We do it through Zoom because it's more effective and we get more done, plus we can record it. And we generally give advice on how your rentals are working, how the numbers work, what is the right structure for you. And we charge $276 including GST for that. But the free chat is exactly that with me. I can help put you in place or set you on to the right person. I can generally help you with sort of easy questions. And I think the financial success plan or financial success review is just a great idea and can really help you. So we'll send you this information out tomorrow. But yeah, my email address is there. And if you just want to book a free financial success review with one of the team at 150 Group, just flick me through an email and we can organize that. Our website has lots of great information, and my newsletter has really good tips and tricks for property investment. Facebook, we put lots of videos up and they will really help you. We look at different properties. Yeah, just really great things. I talked about possibly joining up like Waikato Property Investors Association. New Zealand Property Investor Federation is a New Zealand-wide group. There's 16 different areas, and they generally give you great information for property. There's no further sales pitch. You generally get the Property Investor magazine. It costs sort of $250 to $350 a year. And you just get great information, a great chance to meet other property investors and hear from some great speakers and hear sort of what other people are up to. 150 Group, if you're looking at getting some more advice or that free financial success review, and Value It Details is who does the chattels valuations. So I'll stay online for a couple of minutes, but thank you all for coming along, and hopefully you've really enjoyed tonight and got something good from it. And make sure you look at some of the videos and things online, and hopefully they help you. So thank you very much. And thanks for the nice comments. It's always good to hear that people enjoyed it and got some good information from it. So I'll just leave that there. Thank you very much for everyone who attended, and we'll be in touch. Thank you very much.